China has just made a bold pledge to significantly increase debt in a bid to revive its struggling economy. But there's one major catch. No one knows the exact size of the stimulus package yet, and this uncertainty has left investors on edge. Let's break down what's going on. At a press conference on Saturday, China's Finance Minister, Lan Foan, outlined some key steps the government plans to take. These include helping local governments manage their debt, offering subsidies to low-income households, supporting the property market, and replenishing state banks' capital. These are exactly the kinds of measures that investors had been hoping for as China's economy continues to lose steam. But here's the issue. Lan didn't put a price tag on the package. Investors are now left guessing just how large this stimulus will be, and that's crucial for gauging whether China's recent stock market rally can be sustained. Just last month, Chinese stocks surged to two-year highs, driven by hopes of major fiscal stimulus. But without firm details, those gains have started to slip. Why all the concern? Well, China's economy is facing significant challenges. Growth has been slowing. The property market is in a sharp downturn, and consumer confidence is low. Official data due out soon is expected to show even more signs of weakness, raising fears that China's modest 5% growth target for the year is at risk. On top of that, the country is struggling with deflationary pressures, meaning prices are falling and economic activity is cooling even further. Now, one report from Reuters did hint at some numbers. China is expected to issue special sovereign bonds worth about 2 trillion yuan, or roughly 284 billion US dollars. Half of that would help local governments tackle their debt, while the other half would go toward consumer subsidies, like helping families with multiple children or subsidizing home appliances. But again, until official figures are confirmed, the markets remain nervous. China has already taken steps to stabilize the economy. In late September, the central bank announced aggressive monetary measures, including interest rate cuts and a 1 trillion yuan liquidity injection to support both the property and stock markets. These moves have helped lift market sentiment, but analysts say more needs to be done, particularly in addressing structural issues like boosting consumer demand and reducing reliance on debt-fueled infrastructure investment. One thing is clear. China has the fiscal room to issue more debt. But the real question is how effectively these measures will be implemented. As the world's second-largest economy, any major economic shifts in China will send ripples through global markets, from commodities to currencies. In summary, China's pledge to significantly increase debt shows that the government is committed to reviving its economy. But without clear details on the size and scope of the stimulus package, uncertainty remains high. Investors are eagerly awaiting more concrete information, which could come at the next meeting of China's legislature in the coming weeks.